Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement, Northwestern Ohio's resource for a common sense approach to planning for our financial, investment, and retirement futures. And our resource here on the program for that guidance and perspective is the president and founder of McIntire Retirement Services, Chris McIntire. Chris, welcome back in.
Hi, everybody. Good to be with you today, Peter.
A pleasure, Chris. We always appreciate the time. It's a complex, crazy financial world, and we're just trying to work our way through it to a point where we don't have to work anymore. And it seems to be a challenge in figuring out the direction we need to take. And especially when we look around, it just seems like, I know, 2020 has been a crazy year, unlike any year ever before, but 2021 is probably going to bring a whole lot of the same unprecedented times and events. And certainly we're going to continue to have to deal with risk and market volatility.
No question about it, Peter. There's no vaccine to make this thing go away. It sounds like we'll be dealing with this particular coronavirus for the long term. Even after the vaccine, it will still be out there. It's not like everybody's going to get an inoculation. So, certainly a lot of unknowns. The airline industry is, struggling dramatically. They went from, boom times in January and February of 2019 to nobody flying March, April, May. And I watched the TSA numbers, how many people went through a TSA turnstile, let's say, and those numbers are still, down significantly from a year ago. And, there's been talks of new stimulus for a bailout for the airline industry. And, people can argue back and forth on, are bailouts, productive for the overall economy. And, they did it for the automotive industry, of course, in the 2008 financial crisis. And, here with the airline industry, I don't suppose you can just let it collapse because people still need to fly. It's a major mode of transportation and commerce and, all the support industries that go along with it as well.
Absolutely. Well, Chris, we've got to figure our way through this thing, but more than that, we've got to bring it home to an individual level. What does all of this mean to us as savers, as investors, as those wanting to have some kind of financial security in our life? And it's not necessarily the money, it's the peace of mind that we're all working so hard and striving for. Otherwise, we wouldn't retire. We would just keep working for money if that was the most important thing. It's the confidence and the peace of mind and the quality of life we're striving for. But when you factor in everything that's going on, it's a difficult world, and really we need to bring it home and have the plan that helps define our expectations and our path forward. And that's what you help savers and investors put together there at McIntire Retirement Services.
Yeah, that's correct. We help people time when they should take their Social Security benefits, help them choose pension benefits as well. Do they take the company pension? Do they roll that money into an IRA, create their own income stream, Roth IRA conversions, long-term care pieces? We help folks accomplish and get their estate planning all taken care of as well. So, retirement's not necessarily about a 401k rollover. That's one step in a very large process. It would be a good way to put it, Peter. And we like to, assist people in, helping them make the best decisions. It's not necessarily this is right, this is wrong. It's what's best for your particular situation, which may go against the three other guys you're playing golf with right now.
Yeah, it's not a universal truth. Just because one person, your friend, your buddy, your brother-in-law did something and it worked out, doesn't mean it's necessarily the right thing for us to do. It's all very individualized and personal. And that's why Chris McIntire does offer the opportunity for a conversation. You can start with just a phone call and talking over your situation. A 15-minute call can get you headed in the right direction, can get answers to your specific questions or information on the issues that are on your mind. And if after that 15-minute phone call, it is merited and warranted and would be of benefit, you can come in or you can schedule a time to connect virtually for that longer, detailed forensic financial analysis and the retirement planning strategy session. If you'd like to take advantage of that offer on a complimentary, no cost, no obligation basis to have an experienced, qualified financial resource, Chris McIntire and his team there at McIntire Retirement Services, pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And Chris, when we talk about risk to our financial stability, when we talk about the market and volatility, I think one of the things that is on a lot of people's minds right now, the coronavirus, obviously, the election, another, but there's a lot of fear. There's a lot of angst and anxiety with the financial situation that we're in.
Right, Peter. And, if you look at where people get their news today, it might be a quick feed off of Facebook or Twitter, and that's typically incredibly negative regardless. So, how do you filter out the noise, which there is a lot of noise? Even, many of our mainstream news media pieces now, have some sort of conservative or a liberal type bias to them. And, most folks have their version of politics as well. And, sometimes you just need to, take a step back, turn the TV off, settle down with some of that noise. And, if you're going to do anything, you could certainly read some of the major publications, but 30-second news bite pieces and sound bites are, just quick hits. And, it's a tough time right now. We're certainly more politically charged than we would have been in 2016. And we were pretty politically charged back then.
Certainly. Well, one thing that we've talked about, Chris, with the emotions of investing is that people are motivated by fear. And I recently read an article that really emphasized this in my mind. It said that October is CD renewal month. National CD renewal month is October. And they actually cited that the reason for this was the Black Monday crash in 1987. When the market dropped 20%.
Peter, I can remember that day.
Yeah, it was scary, Chris. A lot of people had fear, but so many did to such an extent that they took their money out at what ended up being the exact wrong time, and they went over and put their money in the bank in CDs. Well, at that time, CDs were paying a much higher rate than they are today. But Chris, we are talking about 33 years later, and October is still National CD Renewal Month because of the fear generated by one down day in the market.
What's funny, Peter, is as you say that, we had a couple of clients here just in last part of September that had a bunch of CDs came due, and we were looking for a little bit of better interest bearing accounts for them. So yeah, I think that certainly rings true. And, as people get fearful of the markets, they move their money, into safer investments typically. So what we've been seeing right now, and even BlackRock, the world's largest money management platform, has come out and said that, as we're heading into this election, they're anticipating more people will move out of the market completely. So they will sell. That will bring prices down, or stock market indices down, move into cash to ride out the election. And that's certainly been a big talking point in our business as well, as you're aware of. Most people right now aren't real sure what's going to happen. Peaceful transformation of power. And, the media hypes it up instead of having the ability to tamper it down and bring things back to an even keel. All the media does is raise that level of anxiety.
Gasoline on the fire. Yeah.
Yeah.
Indeed.
And that's nonpartisan. It doesn't matter which side of of politics you fall on. I think we would all agree that the media has done a terrible job of settling things down in the way and what they perform, because you would think nothing good ever happens in this country if you watch the news. If it bleeds, it leads.
Yeah. Well, I mean, their job in reality is to sell headlines, right? To sell the news, to make people interested in watching. And everything is calm and peaceful is not something that's going to keep people attached and waiting for the next word through that commercial break that they've got to sell.
Absolutely. And yep, they've got to generate revenue and keep people from changing. And, the average attention span, and I can attest to that, it's probably about 30 seconds. As soon as a commercial comes on, most men grab the remote and start channel surfing, and every lady out there listening to the show right now is shaking their heads, I'm sure.
Yeah. Well, I saw an article in Financial Advisor magazine, Chris, that actually echoes the statement that you just made. They said that Wall Street is gearing up for a surge in trading volume leading up to the election, and particularly on election night. Now, the average investor is not going to be able to make a transaction overnight on election night that is going to take effect and going to benefit them. This is really for the institutional traders and the day traders more than the 401k participants, correct?
Oh, absolutely, Peter. And, I could sit here and tell you that, you know, I think the biggest part of the election is going to be what political party controls the House of Representatives and the Senate more so than the presidency in all reality, because, for things to become law, you have to get through the House of Representatives, the Senate, and then the president either signs it or vetoes it. And, you can look here at the Supreme Court nominee. This is why election matters. Why elections matter is the Senate controls the agenda in the Senate judiciary hearings. They're the ones that decide, should, the president's appointee get a hearing or not. And back in 2016, when President Obama was there, the Republicans still controlled the Senate. They did not bring that hearing up for a vote until after the election. So elections have, so the Senate was more important than the presidency at that particular moment.
Well, Chris, are you hearing a lot from your clients or savers and investors that talked to you that they are worried about the election and the results? Wall Street Journal recently published an article kind of asking the question, posing the question, not really answering it, in my opinion, of will a Trump-Biden election tank the market, sink the stock market? And they said they weren't sure if either side would be beneficial or save this from a sinking ship.
Exactly. And I would think, Peter, in all reality, as looking at a long-term investment process is, we don't duck out for a week or two and let the election happen. Most folks may want to get more conservative, take more equities off, and maybe move into more in the bond side of things, especially given the run up that the stock market has had. You could certainly make an argument for that. My technology pieces are up 80%. It's been a ridiculous year. So I'm going to carve off some of those gains, and then we'll revisit this in January after we see what happens with all the elections and whatnot. And, tax policy will matter, but that's a 2021 issue. And, everybody just needs to step back a little bit, reassess what is your overall risk tolerance. Have you had a decent year here where you've recovered from the March lows? And if you have, does it make sense to pull some of that money off the table, slide into more conservative positions, and then reassess here at the end of the year?
Another article I read, Chris, from Morningstar talked about the fact that this year is the first year since World War II where the U.S. debt is set to exceed the size of the economy for the year. Another worrying aspect, I feel like I'm just throwing a lot of troubling articles at you and the news headlines, exactly what you kind of stated the news does. But again, risks are on our mind. People are scared and concerned. You have brought, every time I've sort of thrown an article at you, you've brought it back to the planning. And so I guess that's really where we need to focus the time and attention of the discussion, because that's where we can control things.
Correct, Peter. And, if you look at this, as we're recording the show here, they're talking about another stimulus package to help bail out the airlines. And, it's pretty close to an election. Is it going to be another $2 trillion of debt? So essentially this year, the Federal Reserve has helped to replace what consumers were spending previously. They've, given unemployment extension. So they're replacing income. They've actually replaced the gross domestic product. And hopefully as we get into 2021, we'll get some more treatments. And obviously the death rates of COVID have significantly declined, even though cases may be rising right now. So there's some more treatments, and, they're learning more about how to manage this, and, I think our lives are getting a little more back to normal now in late September, mid-October than they were, in March and April, and I'm spent 20 minutes a day wiping down door handles in our house. I don't do that. I don't spray the mail with bleach. I don't wash everything I get at the grocery store. I wash my hands a lot more often. So, we're starting to normalize. And I would say what would be reassuring for American investors, Peter, and I'm talking institutional to your 401k folks, is after the election, if you had, a couple of the leading powers of Republicans and Democrats come together and say, okay, we spent a lot of money. Now we need to come up with a way to pay for it. You'd probably see the market skyrocket from there, because they're going to start managing the debt. Right now, they're not managing anything other than just, running the credit card up without any discussion on how will you eventually pay for this.
Well, you and I, Chris, as individuals, if we run that credit card up, we've got to formulate a plan to dig ourselves out of that hole eventually. It just doesn't seem like a government has had that day of reckoning yet. But with you and I, again, and all of those listening, workers and savers, if we want to get to a place where we've got stability and a foundation and a structure, it takes planning. It takes careful consideration of what we want that future to look like and then how to get there, and including in that conversation an evaluation of risks. What risks are we going to be facing? How can we address them? And again, ladies and gentlemen, if you'd like to have that conversation, if you'd like to sit down and take a holistic look at planning, if you've got any specific issues, or if you want to know how much risk you're taking, what you're paying in fees, are you getting what you're paying for, the taxes that you'll be liable for into your financial future, how to translate and transition that lump sum you've saved into the income that you will need to rely on into and throughout retirement, how to make any kind of claiming decisions on pensions or Social Security, how to address potential health care needs into the future, and how to navigate this volatile, unpredictable market. Pick up the phone and give Chris McIntire a call. This is exactly what he does day after day for his clients there at McIntire Retirement Services for savers and investors across Northwestern Ohio. 800-868-1194 is the number to call. That's 800-868-1194. 800-868-1194. And Chris, from all of those kind of stories and headlines and examples of why people are worried and nervous right now, backing up and looking at the plan, can we take a 30,000 foot view and sort of define what is risk, and how do I know how much risk I have and how much I should be taking?
Well, yeah, Peter, and we'll go back again to the 30,000 foot level and look at things from just rule of thumbs, kind of where you have to start things off. So we will typically, in a lot of cases, we draw that pie chart where people have their investments. They see it in a pie chart, and we'll say, all right, hey, if you're age 100, okay, rule of thumb says if we take 100 minus your age, that would equal the risk exposure or the stock market risk exposure, right?
Yeah, and important to kind of differentiate, because there's other kinds of risks. Specifically here, we're talking market risk. This is the rule of thumb to gauge that. Okay.
Yes. Yep. Owning stocks and, the ability to go up and down with the prices there, the volatility. And so let's say you're 60 years old, it's easy math. So 60 be more on the conservative side, 40% in equities. And, you can build a nice diversified portfolio in equities of, U.S. large cap stocks, large corporation, medium, small caps, international. So you can build a nice diversified portfolio, look for good quality dividend pieces, and so on. I want to stay at the 30,000 foot level.
Yeah.
Okay? So
Hub cap, baseball cap, different asset classes there, whatever the caps are, mid cap, small cap, large cap. That is different types of investments, different exposures to different sectors. And the theory, Chris, is that they all sort of are cyclical and move in different directions at different times. So maybe smaller companies are struggling where the larger, more established ones are stable and help us preserve some value, correct?
That is absolutely correct, Peter. And so, if we've got somebody 100 minus 60, 40% in that higher risk bucket, then you come over and what do you do with the other 60%? Well, in a normal interest rate environment where you could make 3, 4, 5% in a bank CD, boy, those are attractive. That makes the bond market very attractive as well. But in today's low interest rate environment, we have to watch bond exposure because the yields or the interest rates, yield is just meaning the average rate on all the bonds that are out there. That's what the aggregate yield is. And, in trying to, develop enough income so that somebody can not spend their principal down. That's the idea that most people have when they go into retirement. I've got $1 million. I'm going to spend $40,000 a year using the 4% rule, which is certainly defunct right now. It's not near 4% in a safe withdrawal rate.
But in normal circumstances, we would be shooting for a 4% yield in that case. Try to
Sure.
get
Yep.
the income and the interest to be about what we need for income.
You're absolutely right, Peter. In a perfect world, and we don't live in a perfect world right now, so we have to look at, what are some other alternatives for that 60%? Do we use, still a combination of different types of bonds to lessen still the stock market volatility, create a little bit of income? Do we use something on the, out of the insurance industry? They have some safe investment pieces or safe money places that we use on the annuity side of things to, try to deliver some solid rates of return safely. So again, an asset allocation model for us, Peter, is probably going to be more like an income allocation model where we're going to use stocks, bonds, maybe some quality safe type annuities, and look at diversifying across industries, not just sectors of the economy, if that makes sense.
A little bit more diversification of location, not just asset class there. And again, if that makes sense to you, if you've got questions about it, pick up the phone, give Chris McIntire a call, 800-868-1194, 800-868-1194. So Chris, a couple follow-up questions there. That rule of 100, that is the general premise behind these target date funds that are so common, correct? That if I say I want to retire in the year 2040, then my allocation is sort of automatically balanced between the fixed income and the equity side along the way, and changes and shifts as I get closer to that date or as I'm getting older is the thought process behind that, correct?
Absolutely correct, is to lessen the direct stock market exposure and shift more into bonds. Now, what we have been doing at McIntire Retirement Services in conjunction with our investment platform at Brookstone Capital Management is, in the low interest rate environment, what's the other side of that? And that's where gold would come into play. So, we've got some allocations to gold to counter the low interest rate environment. That usually helps gold prices go up. Right? There's a direct correlation between interest rates and the price of gold. And, the Federal Reserve has come out and said, we're going to keep interest rates very low until I want to say 2024, 2025, let the economy recover. They're going to let inflation even get ahead of its target because it's been so low for so long. They need to let it get ahead of the 2% rate so that things can even out. That should or historically be a good indication for gold there, Peter.
Well, I guess the follow-up to that question, Chris, that rule of 100, it's just a rule of thumb and a starting point. And if you've got somebody that says, I'm not a risk taker, I'm much more conservative, or I like to gamble, I am a risk taker, plus I have a sizable pension over here and other sources of income, all of those factors are taken into account at McIntire Retirement Services. But that's why you talk about how every individual is unique and their recommendations, their plan is going to be specific to them, correct?
Absolutely. We tailor our plans, to the individual investor, from conservative all the way out there to aggressive, from folks that want very low cost ETFs to folks that are really focusing on an income, and not running out of money, to folks that say, look, I got a tax issue. How do we, manage my tax situation? So everybody's got a different set of circumstances. And, you can probably say, hey, we've got clients that certainly would fit into some general categories. I got 100 clients that their biggest focus is income. I've got, 100 clients, their focus is growth. 100 clients, it's estate planning, that type of thing, Peter.
Well, you bring up a couple great points there. One, that taxes are a risk as well. We've talked a lot about market risk, but taxes need to be thought through, accounted for, and addressed as well to help protect ourselves. It's not what you make, it's what you keep. Taxes are often the biggest thing standing in the middle there. And Chris, I heard a subtle recognition in that answer that there is kind of a difference in the discussion of protection of principal or risk that you're willing to take with your investments versus protection of income and the risk that somebody is willing to take with their income fluctuating in retirement?
Yeah, no question about it. If it were me, Peter, having my retirement income set, guaranteed for life for myself and my spouse would be the prominent, the biggest priority I would have, because that's what I'm going to spend is my income. Then can I have some positions in my portfolio where I can handle the long-term growth, and maybe even get higher expected rates of return because I've done planning to live off of my income. It comes from a different bucket, if you will.
So you're positioning those in different ways. Whereas somebody, if we follow that rule of 100, might have an allocation, if they're following it, that is aligned with some amount of equity exposure, even if they're 60 or on the doorstep of retirement, 65 or 70, whatever age that is. There's some amount of fluctuation that's going to be expected and inherent there. Whereas the true diversification that you're talking about, a different location of money for generating income, that might not have the same allocation and risk exposure and therefore expectation for volatility.
Yeah, no question about it. Depending on what the client's focus is, certainly drives the investment side of things, and in mitigating risk is probably a good way to say that. We help to mitigate risk. It is very hard to eliminate it because everything has some side of risk to it, right? A CD has inflation risk, a bond has interest rate risk, has default risk, has call risk where they could cancel the bond and give you your money back and have to reinvest at a lower interest rate. The stock market here, you have, dividend cut risk, so an income risk, you could say, and then the volatility of the price of the individual stocks that you're picking. So, you have to manage risk is what we do. And, it is hard to eliminate it. And, Peter, it's fair to say that the longer your life expectancy is, longevity is your biggest risk. And that accentuates all the other ones we just discovered here. So, how do you manage that? That's what we are. We're risk managers.
Yep. Well, Chris, one thing that has, I guess, become clear to me through the process of doing this program and this show with you is that during our working career, when we have the paycheck, we're showing up to work to earn our income. Fluctuations in the market are not necessarily risks to our lifestyle. Not in the same way they are in retirement, at any rate. If we are in retirement, we don't have the paycheck and our assets are in the market, it's not just our money that's volatile at that point in time. It is literally our life support, our income stream that can have risk and can jeopardize our ability to count and rely on it.
No question, Peter. Hedging that longevity is the key component for most folks in retirement. And everybody out there listening to the show today, or if you're watching us on a podcast, we all have concerns as we go into retirement. Number one is how long we're going to live. Number two is how do we manage healthcare expenses? And, my wife just had one of the big birthdays here as you get a little bit older, not quite to Social Security, to drop a hint there. And our health insurance is now $1,650 a month.
Wow.
So think about that, folks. For those of you that have employer-sponsored healthcare plans, we do not. We pay $1,650 a month for health insurance with a $10,000 deductible.
Yep. Yeah, Chris, another risk here that I know that a lot of people have on their minds is how to pay for that health care, especially if they're planning on retiring maybe a few years early. But that's, again, something that you help them work through there at McIntire Retirement Services. And on this program, we have discussed a number of topics, but the big one that people constantly deal with, maybe it's in the back of their minds, but sometimes it's unpleasantly brought to the forefront of our minds when we see market volatility, and that's the risks that we are taking. The markets are up and down, and if that affects our lifestyle and our peace of mind, then perhaps we're overexposed to that market risk. The market is unpredictable and volatile, but in some ways, it's also a necessary part of a comprehensive financial plan and our long-term objective for growth. And that's why Chris McIntire and his team there at McIntire Retirement Services help to manage that risk. They help to design the plan and pick and choose and balance between the allocations and the locations for your money. And if you'd like to have the help and assistance of an experienced, qualified professional with your management, with your formulation of that plan, pick up the phone and give McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, we always appreciate your time. There's never enough time on the program to go in depth and discuss every angle. It moves by so quick here on the show, as it does in life, and that's why we encourage people not to procrastinate, to pick up the phone, give you a call, and get that plan put together.
Well, Peter, it's good to be with everybody out there, folks. I hope you stay safe and do yourself a favor and mute the TV a little more often.
Absolutely. Well, Chris, we always appreciate your time. Thank you for your guidance, perspective that you share with us and those savers and investors taking their planning and their financial future seriously across Northwestern Ohio.
My pleasure, Peter. Take care, everybody.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.